Today is December 29th, 2025. Another year is nearly gone. Many of us are thinking about our money. We wonder how to make it grow. We hear stories of quick wins. People talk about timing the market just right. But there is a quieter, more powerful way. It is the simple idea that compounding beats market timing. This is not a secret trick. It is a fundamental truth about how wealth is built over time. It is a story about patience. Patience pays, and compounding is the proof. This idea matters to everyone, not just Wall Street experts. It matters to the teacher saving for retirement. It matters to the young couple saving for a home. It is about letting time do the heavy lifting for you. The core concept is wonderfully simple. Compounding means your money earns returns. Then, those returns start earning returns of their own. It is a cycle of growth that builds on itself. Think about a tiny snowball at the top of a very long hill. At first, as you roll it, it picks up a little snow. Its growth is barely noticeable, but as it gets bigger, it gathers more snow with each rotation. The bigger it gets, the faster it grows. Your money can work the same way. The first few years of investing might not feel exciting. The gains are small, but if you are patient, the process begins to accelerate in ways that are hard to grasp until you see it happen over many decades. This essay is a simple case for that patience. It is a 5-minute argument for choosing the long, steady path over the frantic, often futile sprint of market timing. We will look at why compounding is so effective. It rewards patience. It reduces costly mistakes. It helps you control your emotions when markets get scary. And its growth is exponential, meaning time is its most powerful fuel. We will see how being consistent matters far more than being clever. The goal is not to be right all the time. The goal is to stay invested long enough for your correct decisions to compound into something meaningful, giving you the freedom and options that true wealth provides. Financial success often comes down to a few basic principles. This is one of the most important. It does not require a high IQ or a fancy degree. It just requires a shift in perspective. Instead of asking, how can I get the highest return this year? You might ask, how can I stay invested for the next 20 years? The answer to the second question is where real, lasting wealth is found. It is a calmer journey. It is a more reliable one. And for most people, it is the only one that truly works. The magic of compounding is not magic at all. It is just math, patience, and time working together in your favor. The first and most beautiful thing about compounding is how it rewards patience. Our minds are not built to appreciate what small, steady gains can do over a long period. We are drawn to sudden, dramatic events. But wealth is rarely built that way. Wealth is more often the result of not interrupting a process that is working. Consider a simple example. If you invest $1,000 and it grows at 7% per year, your journey begins slowly. After the first year, you have $1,070. You only made $70. That does not feel life-changing. It is easy to get discouraged. It is easy to think you need to do something more exciting to see real growth. But this is where patience starts to pay you. If you leave that money alone, the next year you earn 7% on $1,070, not just the original $1,000. Your gain is $74.90. The extra $4.90 is your return earning its own return. This seems trivial. But let this process continue. After 10 years, your $1,000 has grown to about $1,967. It has almost doubled. After 20 years, it is about $3,869. The growth is not a straight line. It is a curve that gets steeper and steeper. The last few years of a long investment period often produce more gains than the first several years combined. This is the reward for your patience. This concept changes how you view your investments. It is not about what your money did this month or this year. It is about what it can do over the next decade or two. A small amount of money, given enough time, can become a very large amount of money. The force of compounding is backloaded. Most of the magic happens at the end. That is why starting early is such an incredible advantage. A person who starts investing at age 25 has a massive, almost unfair advantage over someone who starts at age 45, even if the late starter invests more money. Time is the most critical ingredient, and it is the one thing you cannot buy more of. So, compounding is a partnership between your money and time. Your job is to provide the money and then have the patience to let time do its work. It is a simple agreement. You stay out of the way. You resist the urge to pull your money out when you get scared. You resist the temptation to chase a hot stock that promises quick riches. You just let the snowball roll down the hill, year after year. This is not a passive act of doing nothing. It is an active choice to be patient. It is a discipline, and it is a discipline that pays better than almost any other in the world of finance. Compounding also acts as a powerful emotional anchor. Investing can be an emotional roller coaster. When the market is soaring, greed takes over. We want to buy more, take more risks, get rich faster. When the market is plunging, fear is overwhelming. Our instinct is to sell everything and run for safety. Greed, fear. These two emotions are the enemies of the long-term investor. They cause us to buy high and sell low, the exact opposite of what we should be doing. A belief in compounding helps you manage these destructive emotions. When you have a long-term perspective, you see market downturns differently. They are no longer terrifying events that threaten your wealth. Instead, they are temporary. They are a normal, expected part of the journey. If you are committed to a 30-year plan, a 20% drop in 1 year is just a blip on the radar. It does not feel good, but it does not change the plan. You know that over the long run, markets have always recovered and gone on to new highs. This knowledge gives you the strength to stay invested, or even to continue investing when prices are lower. Your focus is not on the storm, but on the destination. This calm, steady approach prevents panic selling, which is one of the most reliable ways to destroy wealth. When the headlines are screaming about a crisis and your portfolio is bleeding red, the urge to just get out can be immense. But selling in a panic is almost always a mistake. You are turning a temporary paper loss into a permanent, real loss. A compounding mindset reminds you that time, not timing, is your ally. You are not a trader reacting to the day's news. You are an owner of businesses, and you are in it for the long haul. This mental framework is your best defense against your own worst instincts. Ultimately, this emotional stability saves you money. It keeps you from making rash decisions that you will later regret. Instead of reacting to the noise of the market, you stick to your simple, consistent plan. Save a portion of your income, invest it regularly, and let it grow. You spend less time worrying about your investments and more time living your life. This is one of the hidden dividends of a compounding strategy. It is not just a better way to invest. It is a more peaceful way to live. You accept that you cannot control the market, but you can control your own behavior. And in investing, that is the only thing that truly matters. To see the difference clearly, let's compare two people. We will call them Consistent Carol and Timing Tom. Both start with $10,000 to invest over 20 years. Carol believes in compounding. She invests her $10,000 in a simple, diversified index fund and does not touch it. She accepts the ups and downs. Tom, on the other hand, believes he can outsmart the market. He tries to time his moves. In the first year, the market goes up 20%. Carol's account grows to $12,000. Tom, worried it is too high, sells. He locks in his $2,000 gain and waits for a drop. The next year, the market drops 10%. Carol's account falls to $10,800. She is down from her high, but she stays put. Tom feels brilliant. He avoided the loss. He decides it is time to buy back in. His $12,000 now goes back into the market. The following year, the market has a huge recovery and gains 30%. Carol's account, which started the year at $10,800, grows to $14,040. Tom's account, which started at $12,000, grows to $15,600. For a moment, Tom is ahead. His timing seems to have worked perfectly. This is the seductive nature of market timing. It sometimes rewards you, making you feel like a genius. But this game is hard to win forever. Over the next several years, Tom tries to repeat his success. He sells when he gets nervous. He buys when he feels optimistic. He misses a few of the market's best weeks while sitting in cash. He gets back in just before another downturn. His results become erratic. Meanwhile, Carol does nothing. She just stays invested. Her account value fluctuates, but the long-term trend is upward. After 20 years of average market returns, let's say an average of 8% per year, Carol's initial $10,000 has grown to about $46,610. She never made a single move. She just let compounding work. Tom's results are less certain. Because he missed a few key growth periods and made some ill-timed moves, his average annual return is only 5%. His $10,000 has grown to just $26,533. He worked much harder, he stressed much more, and he ended up with significantly less money. This simple story shows the core lesson. Consistency beats cleverness. You do not need to make perfect calls to build wealth. You just need to avoid making big mistakes and let the power of compounding do its job. The path of patience, while less exciting, is far more likely to lead you to your financial goals.